What a difference a few short months make. It was only a little while ago back in August that the market was in the midst of a sell-off, and the media developed a fixation known as the recession obsession. The focus of this obsession was something called the inverted yield curve. Today, with the markets at or near all-time highs, we don't seem to be hearing as much about the yield curve anymore. I thought you might find it interesting to see where the yield curve is now. What is a yield curve anyway? The yield curve describes the difference in short-term and long-term interest rates. We usually use the 2-year and the 10-year Treasury as our goalpost. A normal yield curve is what's called rising. It looks like a rising pattern, sort of like this. That's because long-term interest rates are higher than short-term interest rates. And that's normal. When we have a declining or inverted yield curve, the opposite is the case. Long-term interest rates are lower than short-term interest rates. This is not normal or usual. Why do yield curves invert? Well, one theory is that investors see bad times ahead. They see a recession. And so they head for the hills, so to speak, by putting all their money into long-term bonds. As they buy long-term bonds, that of course increases the demand. And as the demand rises, that pushes the price of long-term bonds higher, which then pushes down the yield. And when it reaches the point that the yield is below short-term bonds, it then becomes an inverted yield curve. So why is an inverted yield curve important? Well, it's considered to be one of the best predictors of a coming recession. In fact, an inverted yield curve has preceded all 7 of the last recessions, that is, every recession since 1950. So let's take a look at where the yield curve is today. This chart shows the spread between the 10-year and the 2-year U.S. Treasury yields. As you can see, in January all the way through July, the yield curve was positive. However, beginning in August, in accord with the stock market sell-off, the yield curve began declining, and ultimately on August 28th, the yield curve inverted. It then bounced around a little bit, inverted again, but since September has steadily been rising, and the yield curve is once again positive and looking much less scary now than it did earlier this year. It's worth noting that not all economists agree today that an inverted yield curve is that significant. There's a couple reasons for this. One is there's a lot of money coming into the U.S. markets from foreign sources, and some economists think that this may be influencing the yield curve in ways that have nothing to do with the U.S. recession. The second reason is interest rates are so low that it may not have the meaning it once did. We know that recessions are unpredictable, and we also know that they're natural. They're a recurring part of the economic cycle. We know a recession is coming, we just don't know when. And there's no silver bullet for predicting one, not even the inverted yield curve. Perhaps Mark Twain said it best. There's 3 kinds of lies: lies, damn lies, and statistics. If you're concerned about a recession or the inverted yield curve, visit us online or call and schedule an appointment at our Largo offices. We'll help you work towards a brighter future.